Understand the difference between earned income, passive income, and portfolio income, and income that is none of these three and it's totally tax-free, and why. My name's Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of people optimize their assets, minimize taxes, and empower their authentic wealth, and accumulate money for long-term goals such as retirement. And one of my favorite financial vehicles, if you've watched very many episodes on this YouTube channel, is a properly structured, maximum funded, indexed universal life insurance policy. If it's structured correctly and funded properly, it passes the liquidity, safety, rate of return test with flying colors, and it's totally tax-free. And a lot of people say, well, why is it tax-free, Doug? As soon as the IRS finds out about this loophole, they're going to close that. No, it's the IRS who actually dictates why it's tax-free under 3 sections of the Internal Revenue Code. But I'm going to simplify it because ever since 1986 tax reform, that was in President Ronald Reagan's second term, they passed that Tax Reform Act to actually try to simplify taxes and take the highest tax rate, which is over 70% of the time. And back then, bring it down to 2 tax rates, a 15% and a 28% rate. There was this little bubble where they would tax 33% until you had paid a 28% retroactive back to $1. But President Reagan, he didn't believe that any American should have to pay to the federal government any more than 28% in tax. And then states, most states have a state income tax, 41 out of 50 to be exact. And many of these state income taxes were going to be, 5, 6, 7%. In California, I think is the highest, and it tops out, over 13% or so. And so between federal and state tax, then you have to pay tax on these types of income. So let's talk about the difference between these 3 types of income, because ever since 1986 tax reform, these are the only 3 types of income Americans pay income tax on. It's actually pretty simple, but I can't believe how many people don't understand this. And many CPAs, even though they know it, they don't know it. They're like shocked when I teach them this. So first of all, the 3 types of income subject to income tax are earned, passive, and portfolio income. Earned income would be what you go out and you earn by working, and that's usually in the form of salaries or wages. Now, when you earn income that way, you have to pay income tax plus FICA, FICA, and Medicare, Social Security and Medicare. If you're an employee, they're going to subtract, 7.65%. If you're self-employed, you're going to have to match it on your own because your employer has to match that 7.65. And so you're paying out, over 15%. In federal insurance, the FICA, the Social Security, and the Medicare on earned income. So a lot of times people like to get passive income. Passive income would be like rental income off of a rental home or rental apartments or rental equipment or leasing. And so that's passive income. It's just happening. You're not out there actively doing it. So it's passive, but you don't have to pay FICA and Medicare on that. So a lot of people like passive income. Portfolio income is also not subject to FICA and Medicare tax. That would be interest and dividends, the growth on your money inside of investments. So most Americans have almost all of their income, if not all of it, taxed because it's one of these 3 types of income: earned, passive, or portfolio income. So when people read my book or come to my educational events and I talk about my favorite financial vehicle, the L.A.S.E.R fund, they say, well, what does that mean? Well, it's an acronym that stands for Liquid Assets Safely Earning Returns. And what is a L.A.S.E.R fund? Well, it is a properly structured, maximum funded, indexed universal life insurance contract. And if it is structured correctly and funded properly, it really knocks the socks off of most investment accounts like IRAs or 401ks invested in the market and a lot of other investments. It knocks the socks off of a Roth, for many reasons, and I talk about it on this very channel. A L.A.S.E.R fund has 6 major advantages. Roths only have 2. So why would you mess around with a Roth when you can have the 2 advantages of a Roth and 4 additional advantages is what I tell people. So I've never owned an IRA or 401k, never will, because they're going to be subject to tax in these areas, plus they've been tax deferred, and now you have to pay tax on them when you retire. I don't recommend you have your money sitting out there in a mutual fund portfolio unless you think you're going to earn a rate of return, over 15 or 16% average. And if you think you can earn that, you're probably taking some risk, because you have to earn 15 or 16% to net after tax and fees, maybe 10%. In a L.A.S.E.R fund, I only have to earn 11 to net 10, because only about 1% of my rate of return is the cost of the insurance that the IRS says has to be there in order for it to qualify to be tax-free, because the money you take out of a L.A.S.E.R fund is not deemed earned passive or portfolio income. So if I went too quick there, let me reiterate. People say, why is the L.A.S.E.R fund tax-free? Well, simply put, because it is not deemed earned passive or portfolio income when you take money out of your L.A.S.E.R fund the smart way. Now, in this book I want to gift you at the end of this episode, I teach you how you can access money out of a maximum funded insurance contract. If you don't know what I'm talking about, this is the brainchild of E.F. Hutton back in 1980, where they realized that some of the best financial money managers in the world are the multi-trillion-dollar insurance companies and industry. They're the backbone of America and the backbone of the world. They've weathered the Great Depression with flying colors in 2008, when 400 banks went under and 900 more were on the watch list. There wasn't one single legal reserve insurance company that went under. In fact, the federal government asked the 5 major banks in America in 2008 to disclose where they had their Tier 1 assets, that's money they have to have liquid, on hand, and safe in case of a run on their bank, where they had their Tier 1 assets for liquidity and safety. Guess where 30 to 40% was? In insurance companies. And banks are paying you 1% interest back in 2008, and they're turning around and making 5% or more. They're making 5 times what they're paying you. Every million, they were paying $10,000 in annual interest, but they were earning $50,000. And that's a 500% return. But they're increasing the liquidity and safety. But the unique benefit of why I like to use a L.A.S.E.R fund is because they're totally tax-free. See, I like to take my serious cash, accumulate it, and keep it on deposit inside of a portfolio of L.A.S.E.R funds, because it knocks the socks off of IRAs or 401ks. It's working capital for business. It's an emergency fund because you're bypassing the middleman. This is where banks put their money, your money if you put it there. So just bypass the middleman, because you can access money in this day and age within a few days, even based on the internet or electronic funds transfer. You don't need a drive-up window down the street. So I don't care what the uses are, a maximum funded IUL, a L.A.S.E.R fund, is the dream solution for a lot of financial goals. But I do it because I want my money to be liquid. I can access it. It's safe. When the market crashes, I don't lose because my money is not at risk in the market. But I get to benefit when the market goes up and not lose when it goes down, because I'm linking my returns to what the market does using an index, but my money is not at risk in the market. That's indexing, and you need to study the power of indexing on this channel. So liquidity safety, I earn a rate of return. Some years it can be really good, maybe 20, 25%. Even March of 2020 to March of 2021, we had some clients got credited to 61%, even 158% using certain indexing strategies. But generally, over time, if you rebalance and you diversify, you might be able to achieve, based on history, earning a rate of return maybe of 11 and netting 10. But even if you didn't diversify and rebalance, you might earn 9 and net 8, or earn 8 and net 7. But if you do it right, only 1% of those rates of return is actually going to cover the cost of the insurance that makes it tax-free. My point is this: I would rather earn 11 and net 10 than have to earn 15 or 16% to net 10 if I'm in a tax-deferred IRA or 401k. So this is tax-free. Since it's tax-free, I only have to earn 11 to net 10. Does that make sense? And on $1 million nest egg, I can pull out $100,000 a year. And I have to pull out $150,000 a year out of $1 million nest egg to net $100,000 to buy gas and groceries. in a tax-deferred IRA or 401k. Now, people then say, why is it tax-free? Well, it's been a sacred tax-free cash cow in the Internal Revenue Code for 108 years under 3 sections of the code, 72E, 7702, and 101A. I explained this in a book that I want to gift you at the end of this episode. Your money accumulates tax-free under Section 72E of the code. That's been around for 108 years in one form or another. You can access money the smart way under Section 7702 of the Internal Revenue Code. And at the end of the day, when you die, anything left behind blossoms, increases in value, but it transfers income tax-free. Nothing else does that in the Internal Revenue Code. Now, there's 3 ways to access money out of here. The sad way is by dying. That is tax-free under Section 101A. The dumb way is by withdrawing your money. You get to withdraw up to your basis. There's no tax on that. But then you have to start paying tax. That's dumb. You don't have to do that. So the smart way to access money is to borrow from the insurance company. They will loan you money and they will collateralize the loan. You don't have to qualify for the loan. They'll collateralize that with the cash value in the policy. So your cash value continues to earn interest while you are paying a lower interest rate, because they have to charge you an interest rate so that it's tax-free, because loan proceeds are not income. They are tax-free. So if you take a loan out, you could borrow, let's say, like one of my clients in 2017 borrowed $1 million, and he could borrow that out at 2% interest, and they'll credit him 2% on the $1 million of collateral. That's called a zero-wash loan. You could do that, but he feels bullish about America, as I do, and so he borrowed $1 million using his policy as collateral at 5%, and that year he got credited 25%. He capped out on his index. So he made $250,000 on his $1 million. The $50,000 of interest was subtracted. He netted 20% or $200,000 on his $1 million while he was actually using that $1 million, because the insurance company loaned it to him, tax-free to make $2 or $3 million buying and flipping an apartment complex. But the point is this: when you retire and you have $1 million nest egg and you want to just start generating income, you could start taking out, let's say, 10% a year, $100,000 a year, and it's tax-free. Like I said, you'd have to pull out $150,000 out of an IRA or 401k to net $100. $1 million nest egg earning 10% will be drained dry, totally gone in 11 years. A L.A.S.E.R fund, you could live to be 120 years old, and you would still be getting $100,000 a year tax-free. That's the beauty of tax-free. So naturally, people say, why is it tax-free? Why has it been a sacred cow? Well, a lot of reasons. See, because when people take ownership for their own retirement, or they take ownership in case they die sooner than later, and they protect so that the widow and the orphans will not rely on the government, or if they're going to live, they're trying to provide for their own retirement instead of relying on the government to take care of them during their retired years. When you take ownership, you can redirect otherwise payable tax. And so that's why these are tax-free. Otherwise, the studies they have done, it would cost them more than it would make them if they taxed these. So they've always said, leave them alone. But when you get right down to the nitty-gritty, why are they tax-free? Because when you take money out of a L.A.S.E.R fund properly, the smart way, that $100,000 a year I'm referring to is not deemed earned, passive, or portfolio income. If you have income that's not one of those 3 types of income, there's nowhere on a 1040 tax return to put it, okay? The IRS knows you're receiving it. They know everything. But it's tax-free. It's not even worth auditing because it's never been taxable now for 108 years. And so it's pretty much cut and dried. It's tax-free, and that's the value of understanding the difference between earned income, passive income, and portfolio income. But I like to have income that's not any one of those 3, and I don't even have to report it on my tax return. What does this mean? We've helped many clients who retired, and they have a $2.6 million retirement nest egg in IRAs or 401ks, and they think conservatively at 6%, they can withdraw $160,000 a year, and then they have another $40,000 coming from Social Security or maybe a school teacher pension or whatever. And, they have $200,000 a year of income, And they come and say, what do you think? And I go, well, you're a good saver, way to go. But I see one big problem. What's that? Well, 100% of that $200,000 a year is showing up on your 1040 tax return. And they go, you mean there's another way? And I go, absolutely. So it takes about 5 years to do what we call a strategic rollout. And we got 120,000 of that 200,000 off of their 1040 tax return. We took it under a different umbrella. It's not deemed earned passive or portfolio income, it's tax-free. We saved them $1 million in taxes the rest of their life by simply doing a strategic rollout and getting, about 60% of their income to not be deemed earned passive or portfolio income. We had to get the taxes over and done with and convert to tax-free. And this is explained in my book, The L.A.S.E.R Fund, and you'll understand those 3 sections of the code. So I would strongly recommend that you study this book. It's 300 pages. It's my most recent bestseller. It's flying off of our warehouse shelves. I'll gift you a copy free. You can go to Amazon and pay $20 plus shipping. If you do, thank you. But I'll gift you a copy free by you simply going to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll pay for the book, and I'll fire out a hard copy via priority mail. Now, it's actually 2 books in one. This side is about 200 pages with all the charts and graphs and explanations if you're a left brain learner. If you're a right brain learner, you flip it over, and there's 62 actual client stories on this side. But this is not about me. This is about you and your brighter future when you're in there claiming your free copy. If you like to listen and learn or watch and learn, there's audio and video formats. You can even register for a free educational webinar that we do on a regular basis. You can even schedule an appointment with an IUL specialist that I oversee that will help you have some illustrations of how these concepts may apply in your particular set of circumstances. So take advantage of this and begin to prepare to diversify and create the foundation for a tax-free retirement and get 40, 60%, even some of our clients, they have 100% of their income that is not deemed earned passive or portfolio income. It's tax-free. We have a client in California that's got over $8 million. If they earn 10%, that's $800,000 a year. The IRS knows they're earning that, but they know they don't have to pay tax on it. If that's their only income, technically they don't even have to file a tax return. That's how powerful this is.